All right, so the topic that I chose was real estate, and I'll be presenting to you some of the areas that I thought were the most important when it comes to real estate tax planning. So, some terms to know before we start is real estate, which is basically land, building, and any improvements, which in this case, real estate could mean a house. The TCJA is the Tax Cuts and Jobs Act, which is a bill that was passed on December of 2017. Depreciation is the reduction in the value of an asset with the passage of time. A deduction is a provision that reduces your taxable income. Passive income is any income generated without participating in the activity. Real estate is a great way to build wealth, achieve financial independence, and create passive income. According to the census, 67.9% of Americans uh, own a home. So it's important to understand that although real estate is a great form of an investment and a lot of people do it, um, it can affect it can affect your taxes differently compared to other investments like stocks, bonds, or crypto. So let's say that you have decided to buy your first home. Congrats. It's a big step for everybody. But how will this affect your taxes? And most importantly, how will the TCJA affect you? So here are some of the areas that the TCJA affected. And note that a lot of these will be in effect until 2025. So to start off, the first area is the property taxes. So people who live in areas with high property taxes will be affected by the new $10,000 limit on how much state and local tax um, they can deduct from their federal income taxes. Another area is the mortgage interest deduction. Before the TCJA, homeowners could deduct the interest on a mortgage of up to $1 million or 500,000 for taxpayers filing separately. Now, anybody, anyone who takes out a mortgage between December of 2017 and December of 2025 can only deduct interest on a mortgage up to 750,000 or 375 for taxpayers filing separately. Another area is the home equity debt interest deduction. So the TCJA limits the home equity interest deduction to debt that would qualify for the home mortgage interest deduction. And the last area is the home office deduction. Um, Under the TCJA, employees can no longer deduct home office expenses, but self-employed individuals can still claim this deduction, but only if their home office is the principal place of business. Some tax benefits of being self-employed include deducting from the self-employment income a portion of their mortgage interest, property taxes, insurance, utilities, and certain other expenses, as well as the depreciation that relates to that area of the house. But if they don't want to calculate um, all of those expenses, they can use a simplified method for calculating the deduction, which is $5 per square foot for up to 300 square feet. It's important to keep in mind that taxpayers using this method won't be able to depreciate the portion of the home that's used as the office. So let's say that you now want to generate some passive income. So you decide to rent your property. Let's go over some ways that this could affect your taxes. One rule to follow when renting is to know the number of days you rented your property. If you rented it out for less than 15 days in a year, you won't have to report the income generated, but you also won't be able to deduct any expenses that you might have incurred. But if you did rent the property out for more than 15 days, you may deduct rental expenses such as utilities, repairs, insurance, and depreciation against your rental income. Real estate is considered a passive activity by the IRS, and if you show a net income from your investment property, your income will be taxed at the ordinary income tax rates. If you show a loss, on the other hand, you'll need to understand the concepts of active participation and non-active participation in passive activities such as real estate. So here we have the active and the non-active. We'll start with an active. So when you're an active participant, you typically make all the management decisions for the rental property, such as advertising for the property, collecting rents, approving tenants, and other similar activities. One perk that comes to being an active participant is the $25,000 special allowance you can take on any losses against your normal income. So how does this look like? So in this example, you have W-2 wages of 40,000, passive income of 5,000, and you have your rental loss of 10,000. So we have the special allowance of 25, so meaning that you can take the full amount of 10 against your W-2 wages, your normal income. So leaving you with 30 plus your 5, leaving you with taxable income of 35,000 instead of 45. On the other hand, if you're a non-active participant, you'd be subject to the passive activity loss rules, where which state that you cannot deduct passive activity losses against your active income, your normal income. And you can only deduct your passive losses, your rental income against other sources of passive income. So, but if your passive losses exceed your passive income, you may carry forward those passive losses to future years. So in the example, we have W-2 wages of 40,000, passive income of 5,000, and your rental loss of 10. Instead of taking the 10 against your normal income, you can only take it against the other passive income. So you instead of 45, your taxable income is only 40, and the 5 that's left over in rental loss is carried forward to future years to offset future passive income. So now let's say that you want to sell your home. How will this affect your taxes? When you sell your principal residence, you can exclude up to 250,000 of gains, 500,000 if you're married. but only if you meet certain tests. So it's important to maintain records that relate to the original cost, any improvements, casualty losses, and depreciation claimed on any business use. It's also important to note that the second home is ineligible for the gain exclusion. So if you want to sell your second home, it's recommended to convert it into a rental property before selling it. Another thing that comes up when you sell your real estate is depreciation recapture. When you're renting it out, when you have a rental property. Um, so depreciation allows you to deduct a portion of the cost of the property each year on your tax return, which helps you reduce the rent income you report. Since the depreciation is a non-cash expense, there's a you may have a positive cash flow from your real estate investment, but show a loss on your tax return. This is good because you'll have cash in your pocket, but you'll show a loss on your return, which will help you pay less tax. But it's important to note that in future years, you'll have to pay tax on that depreciation in a way. So let's say that you buy a rental property for 200,000 and 150 is the building and 50 goes to the land. And say that you hold it for more than its life, which is 27 and a half years. Um, so then after those 27 and a half years, you sell it for 200,000, which was the same price that you bought it for. But instead of the 200,000, the basis is the 50,000, which is your land. This is because the building is fully depreciated. So your basis is only the land. So it's only the 50, leaving you with a gain that you will be taxed on of 150,000. Some tax deferral strategies, there are two. One is the installment sale, which helps you defer gains by spreading them over several years as you receive the proceeds. Another one is the Section 1031, also known as the like-kind exchange. This technique allows you to exchange one real estate investment property for another and defer paying tax on any gain until you sell the replacement property. And that is all. Thank you.